All right. Oh my God, they started the clock. They only gave me 15 minutes. We got to roll here. All right. Bitcoin, founders and funding. If you're a builder, founder, investor, early stage employee, something, hopefully you get something out of this. If you're someone who's been in private equity or so for like 10 plus years, or you're an attorney, you might find this boring, and it is not for you. So it's for new entrepreneurs or investors. We're just going to do a high-level overview of the venture galaxy. Okay, so let's take a tour. All right, the venture galaxy, the funding cosmos, the final frontier. All right, let's explore and see what we got going on here. All right, so you have limited partners, right? That's LPs for short. That's where the bulk of the money comes from, okay? So it's important to know where a lot of the money comes from in the venture ecosystem. LPs is made up of ultra high net worth people, institutions, entrepreneurs, sovereign wealth funds, family offices, okay? They invest their money with venture capitalists, right? Also VCs, as they say. The general partners, or GPs, as they're often referred to, okay? So venture capitalists come in a lot of different sizes, right? Kind of like Star Trek, you got all these different people out there, all right? And that is, you have micro VCs, they're little tiny guys out there in the galaxy, little tiny firms and funds. You have seed funds, pre-seed, Series A. You have late stage funds, like they're talking about, the secondaries, that's where they focus. You have mid and late stage in the middle there, and sector focused, right? They only invest in SaaS, or they only invest in consumer packaged goods or things like that. Okay, and it's important to know that when LPs give their money to VCs, they expect a return. So they want to invest in high growth, high return companies that can return multiples on their fund back to the LPs, and then that cycle continues, okay, until it doesn't, which is where we're at right now. That's why things kind of lock up. Okay, what do we got down here? Accelerators, right? Accelerators, incubators, studios, lots of different versions of groups that, you know, are set up to, are before the VCs, that are set up to like move faster, okay? And even help build companies themselves. That's what accelerators do. They're before the VCs, and they provide a bunch of other values that hopefully we'll get to in a minute, because I have 15 minutes. Okay, angel investors, those are individuals. They can be former operators or current operators. Syndicates is a part of that world. Tech executives, people invest, they might have specialized knowledge in a particular field. That's where the angel investing dollars come from. And finally, most importantly, you have the founders themselves. You have the people who are actually building these companies. You have the talent that they attract, okay, the teams that they build. And way also on the other side of that, you have the customers, the people that they're actually serving the products for. Okay. So PSAs, before we get rolling, all of this stuff is super important, but like I wanted to have fun today, so why would we even talk about this stuff? Incorporation types, right? Where? Are you going to incorporate in Dubai versus Delaware Sea? What type of incorporations do you need? Do you need multiple incorporations in multiple geographies? There's a lot of things that go into that decision, but I assure you it needs to be done properly because it will have to be done again. Cap tables and options pools. What's a clean cap table? Does it matter? Options pools, setting that up properly, making sure it's sufficient for all your future hires so you have stock that you're able to issue them. All this needs to be done properly. What's in your data room? Who do you share it with? What do you share? At what point in time do you share it with? And how do you approach a VC and make sure your data room or whatever you have at that point is in order before then to make everything else go smoother? Types of instruments, safes, equity, debt, knowing how these convert, how it can affect your dilution in the future. Term sheets, wires, and signatures. Oh my. Retaining counsel. Okay, we've all seen My Cousin Vinny. Okay, and I'm glad that had a good end to that movie, but that is not what you want to do there. You do need a lawyer, but you also need a lawyer who knows what he's doing and has done this before. Because as a founder, maybe you've raised money once or twice. You're up against a VC and their counsel who does this every day. They do this many times. And here's the red flag, okay? You have your brother who's a litigator or someone who's a divorce attorney. They're representing you in this transaction, and they start having problems with things that are just absolutely standard, okay? And that sends up a red flag to the investors. Not only does it frustrate the heck out of them, it sends up red flags to the investors that you are not capable of finding the appropriate service providers for your business. So if you can't get the proper service provider at this point in time in your startup's career, what are you going to do down the line when things actually happen? So it's definitely a red flag that can go off. And then NDAs, right? Idea insurance. No credible VC is going to accept or sign an NDA. Ideas are worthless. Everyone has one. There's actually no marketplace for ideas. Think about it. Where would you go to sell an idea? Nowhere. Because it has no value. So when you're an early stage founder especially, and you put an NDA in front of a potential investor, that really shows them that you're overvaluing ideas and you're undervaluing execution, because that can't be bought, right? Passion, execution, shipping, building, those are things that can't be copied, but the ideas can. Okay, what do we got here? Picking players. All right, bada boom. Okay, so friends and family, there they are. Aunt Mary and Uncle Bob, look at them all in there, that college roommate. Okay, it's the most common way that founders often raise money is from friends and family rounds. All right, so experience. They don't know what they're doing, which is great for you because you're trying to get all their money. All right, it's perfect, it's a great match. All right, the problem is they don't have much money. They don't have much money. Now, there's exceptions to every rule, but typically people don't have a lot of money. So that's why you're not likely to get it. But whatever they do have, you're likely to get very fast. Okay, they're very quick to fund and wire, and they're very flexible about it because they're not even familiar with this stuff. What's a safe? No, they hear buzzwords. Cousin Nick, he's got a startup, angel investment, let's invest, right? This is not likely to be a complex negotiation, okay, with the friends and family. And then future funding, they are very unlikely to invest again. We're just talking generally here, but it usually doesn't happen. So the wild card, you have support. You have support from your friends and family that you're never going to get from any other investor that's on the planet. That's a special type of support. No matter how good that VC is, it won't be a friend that you've had for 20 or 30 years or a blood relative. And the wild card, awkward. These are relationships that you may not want to ruin because these people are friends and family, okay? And it can make for some awkward Thanksgiving dinners. Being around the table. And they likely may not know exactly what they're investing in with these highly illiquid, highly risky investments. They call them friends, family, and fools, right? Because only a fool would invest in their friend or family, especially at those stages. And the score here on this card is 21 for these investors. I think that's important. Uh-oh, I hit blank. Okay. Angel investors, okay, that's usually the next area of funding, okay? They are way more experienced, and you can get way lucky. You can get a quality angel that can really do a lot for your company at these early stages. They certainly have more money. Okay, they have more experience because they've been doing this. They're not as quick as friends and family, but serious angel investors do pull the trigger quickly. They definitely don't wait around. They're easier to close. And they're not as flexible because they have some experience in this space. So there's some negotiations that might happen here surrounding some other key terms of the deal. And then future funding, they could invest again, but it's not generally a real source of follow-on funding. You don't really go back to these individual angels. Now remember, this is before the VCs, is when these angels technically invest. Wild card, you can get super lucky. You can get an angel that can help do more for you than anyone else if you get lucky. And then the wild card is they can be super annoying. Someone cuts you a $25,000 check, they could just be a huge pain. And that could happen, okay? So it's something to think about. And the score on that card, again, 21. Okay, the VC, right? The holy grail, all right? And all the signaling that comes from it, okay? The press release, the stamp of approval, okay? And they're potentially too experienced, right? They're the ones with the dollars to deploy. And they certainly have dollars, right? They don't move quickly. They're going to put you through your first real due diligence. They're going to have a slew of questions. They might want you to build some visualizations and data. It's going to take longer to close this deal. Flexibility, not so much. This is going to be your real first negotiation will be at this point. And then future funding. They are likely to continue investing in your company, although sometimes forcefully, even when you don't want them to, right? And that would be by enforcing pro rata rights, and that's another thing that comes along with this, or certain other things. All right, so power, they can help you a lot, and they can be controlling, especially when you get to the Series A level. Maybe you're giving up board seats, maybe there's a certain control and governance aspect to it, so definitely something to think of, and a score of 21. Okay, accelerators. Now, they're in before the VCs, and this is access to mentors. This is a program, right? The founder boot camp, all right? Loads of experience and quality introductions. Okay, this is what they do. They put you through maybe an 8, 12 or so program to teach you all these things, how to iterate and product market fit and what you're doing. And they can do a lot for your business, okay? Capital is high because what comes along with an accelerator is usually introductions to other capital and other people in their network. So as you're going through or completing an accelerator, they will book meetings with you, with all of their investors in their network, okay? You still have to close them, of course, but it's a lot of great intros on the capital side, so it could be extra powerful. Speed is, you have to apply. They only have a certain number of cohorts. There's usually timing. So it's not necessarily the quickest way, and you don't know if you're going to get in anyway, and then you're going through a 12-week program. Flexibility is not so much, right? Because you applied to go through their experience, okay? So how flexible is that? There's a curriculum. There's things that you have to do. You're back in school now, okay? And then future funding, not really. They don't really invest again in the future. Sometimes there are small funds that can invest again through accelerators and startups, incubators, but not likely. Okay, wildcard FOMO. Oh my gosh, it's the latest YC batch, and they're in there and that, and and that's great. Okay, and then the wildcard, there's a negative, is of course you're back in school. All right. And that score was 21. All right, syndicates, woo, my favorite. All right, so if angel investors are powerful, right, just on their own, then a group of angel investors together is even more powerful, right? And that's what a syndicate is, or an investing group. They might be geographically located. Maybe there's the Miami Tech Angels, or there's certain ones that just focus on certain sectors, right? But these groups or syndicates kind of band together as angels to pool their capital and then try to help and support these companies. That's what we have at Lightning Ventures. We have a very active syndicate. The capital is meaningful. In a real market, I mean, you can get 7 figures done from a syndicate. That's not really the case right now. Things are a little tighter, but it can be a great source of capital. In terms of speed, this is low because that's the current environment. The speed is not fast, okay? But if you see down here, the wild card is it can be really fast, okay? When the market is much healthier, you can have a syndicate from day one to the wire in your account in 10 days or less. It can be super powerful, but you're subject to the market conditions, and right now they're not great. Flexibility, there's some, but not really. There's going to be some negotiation on pro rata, maybe potentially evaluation if it's one of the first syndicates in. It's not Aunt Mary and Uncle Bob, but it's not a VC. There's more flexibility that comes along with that. And then future funding, you can likely always get more money from syndicates because syndicates want to keep investing. They want to keep rolling out allocations. And that's what goes along with that as far as future funding. And that score was 21. All right, crowdfunding. Okay, imagine Aunt Mary and Uncle Bob. We were talking about them. Now you got 1,000 Aunt Mary and Uncle Bobs, and they each invested $100, okay? That's what's going on here. So it's hard to manage that large group of people. It serves certain companies very well. If you're an established company and you roll out a crowdfunding campaign, it can be great. It's a way to engage with your super fans, your core users. They can feel good. They invested in your company. Some capital is there, but that depends. The companies that can go out and raise $5 million on a crowdfunding platform really don't need the $5 million. You know what I mean? They're that big of a name. The companies that usually go out, they raise $100,000 and then $40,000 gets eaten up by fees, and it's not necessarily the best experience. Very flexible because you can roll it out when you want. You can even pick your own terms. You can say my company is worth X, and that's unique to crowdfunding versus the other platforms. My company is worth X, and you roll that out there, and then you see, let the market decide. In future funding, you can always go back to crowdfunding, but you may not want to. The wild card that's positive here is you get a lot of eyeballs. A lot of eyeballs on your company because the crowdfunding platform that you're working with, they're going to do some free bare bones marketing to their captive audience that they send out in their email list. You're going to get a lot of clicks and traffic, probably more than you've ever gotten. Okay, and then they're going to try to sell you other marketing services to promote your deal, which smells like a scam. All right, wild card, loyalty and privacy. Okay, these investors, the $100, they are not very loyal. They're waiting to sell whenever they have an opportunity to, unlike the rest of these investors. And if you think the privacy in a syndicate can be a challenge for your business, you got no privacy here because everything's public, everything's registered, it's all on the website, and anyone can see it at any point in time. All right, investor matchmaking. All right, so first off, how much money do you want to raise, and what will you do with it? Okay, this is a type of financing that's called milestone-based financing. Okay, it rewards the entrepreneur based on hitting certain goals rather than, oh, we're going to raise a slug of money and then we have 18 months of runway. Okay, I'm a big fan of milestone-based financing. Once you know what you want to raise, you can actually then target the appropriate VC funds based on that, okay? And you can tailor it to them based on if they're a pre-seed or a seed fund. You want to really talk to other founders in the space, get their take. You know, find out who they raised from. Don't just send a blanket email to everyone. All right, and you know, what values must you align on, okay? When you take money from an investor, you want to be able to keep the small stuff small, all right? So that when the big things happen, that's when you can actually really jump in, okay? You want to make sure that your values are aligned in advance because remember, these are long-term relationships. You're going to be with these people for a while. And, you know, life is too short. My life is too short. It's certainly exactly true for the entrepreneur to work with people you don't like, to work with people you don't want to spend time with, to work with people who don't build you up, okay, when you talk to them. Okay, that's what you want. You want people that you might get out of bed at 9 o'clock at night on a Sunday night to take that call, okay? So no one's money is worth being a problem. Okay, and that's important. So every founder is like, you know, to the VC trying to pitch, you know, you should also ask that VC what they're going to do for you and check a few of their references with some other of their portfolio companies or so if you can. All right, so finally, this is it. This is Lightning Ventures. I know it's QR code overkill. So top right is our website there. If you're interested in investing, you can fill out this little form that we have here, and you'll get a custom invitation from us. It'll be a quicker onboarding process. If you're a builder or founder and raising, the QR code in the middle, you can tell us a little bit about what you're doing. And then if you are interested in our Node Fund 2, which I believe that page is just live as of today, that is that. And if you liked these slides, my buddy Toshimoto is in the room, and he's looking for some graphic design work too, and we love him, and we try to help him out. There he is there with the headband and the glasses. But anyway, I didn't have a slide about me because if there's one thing to take away here, it's not about me. It's about this other stuff. But I'm Mike Jarmuz. My friends call me Muzz. Our company's Lightning Ventures, and I'll be around all day to hang out and chat.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.